Welcome to the Life Unlimited podcast with Larry Heller. You deserve complete financial advice so you can confidently live your life your way, for life. Now, let's get into this week's podcast episode.
Hello, and welcome to Life Unlimited with Larry Heller from Heller Wealth Management. I'm Eric, Larry's producer, and I'm here to learn along with you, the audience. Larry, how are you?
I'm doing terrific, Eric. How are you today?
Oh, I'm doing fantastic. I know we're talking about something that's on a lot of people's minds today.
Yes, we're going to be talking about inflation and financial planning and investments and some of the steps that you should take by what's going on with inflation out there.
Yeah, I've heard, the cuss words that people use. They usually reference them by the first letter. I've never heard the I word as a bad word, but right now.
Well, it definitely can be if you're going to the supermarket, buying a car, getting a mortgage. The I word's right up there.
All right. So what are we learning today about inflation?
Yeah. So let's just talk a little bit about inflation. So for the year ending April 2022, inflation now is up to 8.3%. So for those of you, like I said, have gone to the supermarket or looking at things to buy, things are more expensive. In 2020, and I think it was May of 2020, inflation was just about zero. So we've in 2 years, we've gone from zero to now like 8%. Just to give you some perspective, over the last 20 years, inflation was, I think it was about 2.86%. And over the last 100 years, inflation has averaged about a little over 3.26%. Wow. So some may say that, we're due for some higher inflation because we've been in an environment of real low inflation for a long time to kind of even out the averages. And so we're seeing that we're down a little bit in April, but still up there. And that's why the Fed has started to raise some rates to keep inflation under control, raise the rates and try to keep us out of recession. We'll see how they do. And that's causing a lot of different issues. So we're going to talk about some of the things that inflation is affecting and some of the things that you should do.
Okay. I mean, you said May of 2020, right? So it's like pandemic. Then 2021 was different variances of COVID and the pandemic. We couldn't get out of it there. And then all of a sudden now 2022, we're thinking maybe light at the end of the tunnel. No, let's get some inflation in there. We need a break,
and inflation's been low even before the pandemic. So that, it's been low for many years. So but now we're back up higher, and pandemic may have something to do with it. But So what are some of the things that you should be concerned about by both the planning and the investment side? So let's just talk about, the personal planning side, whether you're saving for retirement or you're in retirement. If you're saving for retirement and your expenses are up, maybe your savings are down. So you want to kind of look at that and see what it is. And there are some adjustments that you can make. And if you're in retirement, the amount that you need to spend is probably higher now than it has been in the past. So what are some of the things you need to do? And especially when you're looking at possibly retiring in the near future, how do you factor in the inflation, both near term and long term, so your retirement plan is working properly? So if you don't have the right increases in place, your plan may seem that it's working, but as these costs kind of increase, what does that mean? And how does that going to affect what you're trying to do? So looking at your expenses, trying to figure them out and trying to figure out how do you adjust for some of these, and some of the planning is important.
Yeah. And one of the things you've spoken about on podcasts previously is protecting yourself, protecting your finances by making sure that you're watching, not necessarily your budget, but the things that you spend money on, because like subscriptions, for instance, is one thing that I remember you mentioning, is that a lot of times we get subscriptions and we just forget about them, and that's a drain. And right now people can't take that, extra going out when they're not using it. Right.
Well, yeah, nobody likes to waste money, but a lot of people are also staying in with the pandemic going on. So there's a lot of subscriptions to a lot of different things out there, but maybe they're saving money by not going out as much. Hopefully this little spike we're having will not continue to go in the wrong direction.
Yeah. So what else do we need to learn?
So let's talk about cash and cash strategy. So if you have listened to one of our numerous podcasts, that if you're close to retirement or in retirement, we'd like to keep about 2 to 3 years of your expenses in cash. Why do we want that amount of money in cash? Well, because when we go through areas that we're going through now and the stock market is having a little bit of a downslide or correction, we want to be able to ride out any of these downsides. So we want to have enough cash so we can continue to spend what we want to spend in retirement. So if expenses are going up, your cash position needs to be going up. So that's one thing to keep in mind when we're talking about cash. The second thing is your money market account. If you're not earning any money on your money market accounts, or very little, and now inflation is going up, you can actually be losing money by keeping too much in cash. So we've got to figure out kind of what we do and how do we put together an investment strategy. So we want to have enough cash, especially if you're close to retirement, already in retirement. But we want to make sure that we stay ahead of inflation with your investments so you can spend more money as expenses continue to go up.
Mm-hmm. That makes a lot of sense.
Yeah. So let's talk about investments. And one of the things that we want to do, and some of the things that you can have done, we have done some of the things that have worked in the past with inflation. So let's start with stocks. So typically long-term returns from stocks have outperformed inflation. That's why we want to have stocks in our portfolios. It's a good hedge against inflation. Of course, short-term, again, as we're having some of these corrections, it may not seem like that it is, but we do need to have stocks in our portfolios for long-term to stay ahead of inflation.
Yep.
Another investment to use as a hedge against inflation is Treasury inflation protected securities that will go up if the expected inflation rate is more than the inflation rate. So we've actually had this in place for over a year, and maybe now you want to keep it, maybe not, but that's one thing to look into as part of investments. Another thing is commodities. Commodities longer term have not been a good performer, but against inflation this year, commodities does. Oil is going up, and commodity funds have gone up. So that's another investment to consider in your portfolio. So bonds and how that relates to inflation. So as I mentioned earlier, as the Fed has been raising rates, the value of bonds have been going down. So this year we've seen both the stock market go down and the bond market go down. So you really want to kind of look at your bonds and see how they perform. The good news is, as the Fed has raised rates, that interest rates are going to go up. That means the bond rates are going to go up on new bonds, new CDs. So as the interest rates rise, we are going to hopefully get some nicer returns on our fixed income investments. Moving on, and some of the other steps to kind of look at or just be aware of it and what inflation does. And one thing that I call is tax bracket creeps. So you may ask, what is that, Eric?
I'm very curious now because
okay.
Tax bracket creep.
Tax bracket creep. So in the tax code, you pay taxes based upon how much money you have. So there's different brackets. And the more money that you earn, the higher bracket that you're in. Well, those brackets are adjusted for inflation. So now as the amount and the brackets are adjusted for inflation, so your taxes actually can go up based upon the inflation. So if you don't earn more money and your tax rates go up, that's what I mean by tax bracket creeps. So, and some of the other things are, there's fixed numbers in the tax laws. So even though inflation may be going up, some of the things are capped. For example, the amount of money that you get to deduct if you're selling a home, if you're single, it's $250,000 off of your taxable, off of your gains. If you're single, it's $250,000. If you're married, it's $500,000. Well, that's a fixed number. So as the gains go up, because inflation is going up and home is going up, you're going to pay more in taxes because the amount that you're able to protect is flat. Mm-hmm. The same thing with the SALT deduction, which is limited at $10,000. So the amount of money that you're allowed to deduct on your state and local taxes is fixed as $10,000. It's not going up by inflation. The amount of money that you're able to write off in losses for a year, it's still capped at $3,000 a year. So there are some tax limits in there that are not hedged against inflation, which will kind of work against you. And then there are some in there which will have you paying more money. So there's tax bracket creep, and the inflation could cause you to pay more money in taxes, and you may not be earning more money. So it's interesting on some of the inflation impacts that they could have.
Wow, I didn't know. I don't think I knew any of those. I didn't even know that. Especially the tax bracket creep part of it, where I didn't know that they can increase with inflation.
The brackets will adjust for inflation.
Yeah.
So to keep to keep the government getting the right amount of money on their taxes. Yep. Well, that's what we're here for, to kind of tell you people out there what some of the impacts could have.
All right. What's the next thing?
So the next thing, we're going to shift gear in a little bit more of a planning idea, and probably people forget about this. So anyone who's buying a new house, do you know anyone who's buying a new house, moving into a new house now?
There's tons of people buying. I just sold, and we talked a little bit about that, but I'm moving into an older house that I've already owned. So
okay,
I don't have to buy a new one.
That's even a better item to discuss, because what people do is they move into their house and they get their property insurance, and they forget about it. Every year the premium goes up, but they may not look at some of the numbers in there. And why is it important to look at some of those numbers in there? Because the assessed home value may be fixed. So therefore, if you have a house fire and you need to replace it, guess what inflation does? It's driving the cost up of fixing them. So your assessed value needs to be adjusted, and you need to look at your insurance and make sure your replacement costs can be adjusted by inflation.
Yeah, I forgot all about that. And you're absolutely right, especially right now with supply chain issues. I think that, the price of lumber is still high. So if they did have to replace it, I can't imagine what it would be compared to what it's insured for. So now I have to talk to my wife about looking through that paperwork.
There you go. You got, and you may have proper coverage in there that accounts for that. But then again, if you have a total fire that burns the whole house down, there may be assessed value in there that's not enough to cover rebuilding it. So we urge everyone now to be talking to their insurance broker and reviewing their policies to make sure they have the right coverage with increasing inflation and with increasing costs.
Would you say that older homes have that issue? Because the house we're moving into is built in 1903. And so I think there's a lot of people that have older homes, and maybe the value isn't as high as, not nearly as high as what the replacement value would be.
Right. It's not the home, the older home. It's the actual insurance policy that you have. Some may adjust by that. Some may be, I'm not an property casualty insurance expert, and we refer those out, but it's the policy and the type of policy that you have to cover for those going forward. So you don't really have to worry about that. Yeah. But so it's a good time to review that, have your current insurance agent look at it, or have another insurance agent look at it and get an opinion from them. Sometimes it's not just saving money on the premium, it may cost you more, but you want to be sure that if you have some type of damage, a hurricane damage, a fire, a water damage, that you're going to not have to come out of pocket for costs that you were surprised by.
Yeah, absolutely. Absolutely.
And let's talk about another planning technique, not technique, but an issue when it comes to inflation. So we talked about rising interest rates. So mortgages. So if you are looking to take out a new mortgage now, interest rates are going up. So therefore, what type of mortgage you're going to be able to take and what can you afford? The Wall Street Journal actually did an article about that if you're buying a new home in construction and you're at the whim of the builder, and you might have started this when interest rates were down around 2, and now they're in the 4.5, 5.5 range. So looking at your potential mortgage if you're buying a new home, and also paying off a mortgage. So one of the strategies sometimes has been to pay off a mortgage and you're getting a fixed rate of return. And I always tell people we've done some of these podcasts, and there's 2 reasons for having a mortgage or paying off a mortgage. One is the financial numbers, and one is kind of the sleep factor that I've talked about. So we've always talked about paying off a mortgage, and when interest rates were really low, the rate of return may be higher if you're paying off a higher mortgage and didn't really want to refinance. But now that may be starting to change as interest rates become higher. Maybe keeping the mortgage is longer. So again, looking at the mortgage, looking at your current mortgage, if you're getting a new mortgage, it's really more interest rates, which are being driven a little bit by inflation, but it's really the mortgage rates there. So these are just some of the things that have an impact on what's going on with inflation. But you should look at all these planning ideas and making sure that you're factoring in inflation in both your investments and your financial planning.
Yeah. And these are a lot of areas. I mean, Larry, you covered probably 7 that I can think of. And that's a lot to keep track of. Can you give people your contact information? I know that you'll work with anybody who, speak with anybody who calls in, but there's a lot of people that probably work with an advisor and maybe they're not talking about this kind of stuff and they need a second opinion.
Absolutely. So you can go to our website, hellowealthmanagement.com, and there's a little button on there that you can click to set up a free 20-minute diagnostic call with myself or one of our advisors, or feel free to call the office at 631-248-3600.
All right. Any other closing thoughts for today, Larry?
I know it's tough out there between inflation, between what's going on in the equities and bond market. So maintain your strategy. Don't just panic. Have a strategy for all these different areas and stay the course.
Yeah, absolutely. Great advice, Larry. Thank you so much for your time today.
Great to see you again, Eric.
Thank you again. And of course, thank you for listening and tuning in to the Life Unlimited podcast with Larry Heller. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Larry comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Heller Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.